So things look dire, right? So this is your host, Proforma24. We're gonna do a more in-depth review of the SPY, see where things are going, and what happened. My comments on what happened this past week. So I have the SPY pulled up on the weekly bars, and notice that this is the 20-period moving average. And I want you to count with me, right? Here's one down leg. That's A, B. I'm going to call this as C, D, and E has to come, right? So I don't want to be sounding warning bells here, but there's a higher chance that we do head down than it is to go up. Last week, I talked a lot about like the opportunity that we had to move up, and we were right in that until Friday, right? So Friday made this somewhat of a doji bar. I'll be liberal with that and call it a doji bar. And so it's one of those things that you always have to really, really be careful to make judgments and biases way ahead of time. But if we look at this, we had a push to the top and it was rejected down. We did close about the weekly midline. Let's see. Oh, just below it looks like. So that's tough, right? So that's, it could get ugly here, guys. let's hope that this is just one of those things that we react to this bottom number and that we push up. But the reality is that we're below this volume profile, and it really starts to get thin. Right below it, there's a thin area here. And so at the very least, we'll get to midway of it, which is 354. But the reality is we could slide, right? So let's go over a little bit the economics behind it. If you guys aren't kind of aware of where the stock market grows, like why it grows, let's talk a little bit about auction, right? So if you've ever been to an auction, you say, $100, and somebody comes up and says $105, and somebody says, going once, going twice. That's basically the intent of what the market is doing. And the way it works is that there's more participants with money, then they can push the price higher because they're like, no, I want it at this price. Oh no, I want it at this price. So it goes up. When there aren't as many buyers, then what ends up occurring is the group that's there that may be buying, they're like, oh, I could probably get a lower price and not bid right now. And so it drives it down, and then you get this mentality that everybody's waiting for the next low. Obviously, in the stock market, there are people that will benefit if the market goes down. So it's like a two-edged sword, right? It's like you can drive it up real quick, but you can also drive it up real down quickly. And so before I get into that, I really want to talk about the expression. I heard it from a friend that bears jump out the window and bulls go up the stairs. So I always found that to be that graphic to be funny. But the idea is that when things are going up, they go up slowly, and when things go down, they go down fast. Now that has been my experience, but yesterday was interesting, right? If you were trading yesterday, you saw like a slow developing downturn. Usually it's like you get one or two big moves and it just stalls, right? So I found that interesting. But getting back to the economics of the market is that you basically need new money to come in. And where does new money come from? New money comes from people having money and having jobs and creating wealth. And what happened, and this is my theory, obviously, but these are the ideas that I use to make my decisions. And yes, I am a profitable trader, very profitable. So I tend to be right with these things. And part of trading is that when you're wrong, you got to change your mind real fast and see and check later, like what is it that you missed. But overall, when we had COVID, this was our high up here. This number right here, which is about 338. Right? And then the mandates came and we flushed down. We went from 338 all the way to 228. I mean, that's hurtful. But then they implemented easing, right? So what that means is that the Fed injected money into the markets to have this push up. So remember, we like all this right here was not wealth created. Sure, there are people working, but I bet you can still identify people that I still like not working big time. I know we saw the NFP report, which is the reason why things jumped down, like went down real fast, as the NFP report was higher than expected. They wanted 250 jobs gained, and we got 263, signifying that the economy is strong, so on and so forth. But I would say, if you look at the earnings that are being projected by AMD, Nvidia, and Apple, even, they're expecting less demand. They're expecting less orders. And so, of course, if there are less orders and less demand, even Amazon, I read a report that they stopped hiring, which is like as far as the executive level positions. So what is that telling you? That is telling you that perhaps we're getting a big slowdown coming up. And then since COVID, we really haven't hit full force in the economy, no matter what they're showing you. We really haven't hit full force. Sometime a couple months ago, I went to look for outlets at Lowe's, and they didn't have any. I mean, it's just a regular old outlet that I can put in. There is nothing. So what does that signify? And what's my point here? My point is that this move up, I'm not saying 100% just money. Obviously, some company wealth and profits that came in and drove this market up. Yeah, and this is the weekly. Weekly makes it look a little bit just more palatable, right? I'll switch to the daily here in a second. But my argument here is that the going concern, and if you understand cash flow analysis and if you understand pro forma, what I'm trying to say is that whenever you do a valuation on a company, there is an assumption at the end that there is a forever growth, a going concern of that company. And you make a decision, hey, at the end of this, I think the company's going to grow at 5% from here on. And you make that assumption, or 3% assumption. And in fact, that number tends to be the major value of the company, like 80 to 90%. So if there's really no big going concern, no wealth being created on a weekly, bi-weekly, monthly way, where the employees that are working there are bringing home money where they can go buy things, and they're not putting money into their 401k, then perhaps we head back down here to this level at least, right? And what's interesting is that you know how things work. You've driven a car and hit the brakes hard before, right? You don't stop immediately, right? So let's say this is where we have to hit the brakes, where there's going to be a little slide down, hopefully not down to here, but a little slide down and then go back up. So I think we're in a difficult position for bulls. I think that when you look at this price action, this is not a palatable move. There is a negative divergence that happened on the MACD. There is a double backing. What I mean by that is we're starting to see this MACD curling back down on the daily. I mean, I just showed you the weekly, right? The weekly really double back down. That's not very good. That's not good at all. So look, I don't want to make this like a thing where everybody panics, because the thing about panics and all that is most of them are psychologically induced. When a mass of people think the same way, that's when these occur. And bank runs and all those things, they occur when everybody thinks one way and they go that way. Now, my general opinion is when everybody's thinking one way, things go the other way. That has been my experience. The problem is when it doesn't go the other way, we get a massive move, right? So, reviewing objectively the numbers, forget my bias, forget the ideas that I'm talking about. What does this look like? So, this is the daily bar, right? We had a 1, 2, 3, 4, perhaps the fifth leg down, right? The fifth wave down, if you like that Elliott wave theory. This is very interesting price action. Very interesting. Just like this one. Very interesting price action. This tends to tell me, look, big gap down here. This was really an interesting thing, right? Tried to save it. Came back down. I was okay with this move. This is the one that I thought was very interesting. Like, that's almost out of place, right? So, and it maybe should have gone a little longer, right? What's that move? Let's take a look at the Fibonacci real quick. From there to there. Yeah, right? It got to the 50%. It got to the 50%, as you can see, right? Right here. And then it gave it up. I like retracements back to 61.8 to feel comfortable with them. Just because it's more natural. So where are we here? Like, what are we seeing here? Let's look at the highest high recently, which is here. And let's draw the Fibonacci down to that downturn. Right here. What's the retracement? 23.6. Those retracements, when they happen right around there, it's no good. So, by this telling me we like a more natural move, at least to 50, right? To 61. And then it's okay to move down. But a lot of weakness is what we're seeing. Lots of weakness. So next week is next week or two, right? We see a high probability of things really sliding down, unless there's some kind of intervention that happens. If the Fed comes in, I know the banks are meeting, and I saw an IMF report saying that, hey, instead of rate hikes, let's do price ceilings. By the way, that's a huge mistake. That is like old economics ideas. Whenever you put a price ceiling, you got to put a price ceiling all the way down that supply line. I'll give you the example. So milk is expensive. All right, let's fix the price on milk. Well, what about the farmers that have to buy seeds for the cows? Are you going to put a price ceiling on seeds? Okay, let's do that, right? Okay, well, what about the payments for the farmers that grow the seeds on their mortgages or for their land? So are you going to reduce the payments for that? Because they need to make a certain profit in order to make their payments. So let's reduce the mortgages. Oh, okay, let's do that. Okay, further down the line. Okay, what about the investors in the banks that lent that money to the farmer? Now they're going to get less money? Are you going to put a price ceiling on that? No, at some point, somebody is like, who gets left holding the bag? If it's got to be the government, that there's only so many things you can do, right? So we're already at $31 trillion in debt. So the short of it is that we need a quick turnaround here. If not, I mean, look, this is a rounded top that I'm seeing. You know what rounded tops look like? It could go boom, and then it rises up, and then we get a reverse cup and handle. That's never good. We want the inverse, the regular cup and handle, because we know things blast off. So for next week, I would be looking to sell any pops. I would be looking to add to shorter positions and puts. If you're going to do any bull puts, make them wide, right? Just in case there is a nice pop, you can make quick money. I really pray that these things really rise quickly. So that's my analysis here. We're looking at the weekly. Weekly is very bearish. The daily bars are also, we are double backing to the bottom. We haven't turned down yet, so there's a chance here that we do move up. So I hope that's what happens. And then if we look at the let's look at the 1 hour chart. That last hour, we saved something, right? We're battling these gaps. It's a really wide gap here that occurred. I'm just gonna be liberal here and just highlight this gap. Lots of volume here. Maybe we can come back and attack it and move up. So anyway, like us, subscribe if you find value in this. I'm going to be doing more of these videos a little more often, and I'm going to try and add a little spice to it. So I hope you guys guys stay here and